A 10% decline pricing and a 40% chance of a recession. I think we're probably more in the category the market panicked because there's a lot of uncertainty right now. But I think we're going to get through this. I think investors are going to realize that a lot of great stocks have come in, hugely. And the S&P's down 10, but a lot of good stocks are down 50%. And I think that's why, there's a very good chance we made our low for the first half already, or maybe for the year.
According to Lee, the stock market decline we've seen, about 10% in just 20 days, qualifies as a waterfall decline. This term refers to a rapid and sharp drop that can either be the beginning of a deeper crisis, like what we saw in 2020, or a panic-driven overreaction. In this case, Lee believes it's the latter. The market, he argues, is pricing in a 40% chance of a recession. But this may be more about fear and uncertainty than actual fundamentals.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I think the market's trying to catch its breath right now because we had 2 years of 20% gains, so we know a lot of good news was priced in. And now with a new administration and really a bold plan to use tariffs, to sort of fix the economy, and this part of a bigger plan to fix taxes and DOGE to cut government spending, there is a natural, markets want to sit on their hands and wait and see what's happening. And so I think that's why we've had the kind of decline we did, but 10% in 20 days, that's a high-speed decline. That's what we would call a waterfall stock market decline, and there's something that you should be mindful of. A waterfall decline can be the start of a crisis, like that happened in 2020, or it could be just the markets panicking. And with a 10% decline pricing and a 40% chance of a recession, I think we're probably more in the category the market panicked because there's a lot of uncertainty right now. But I think we're going to get through this because we know there is a Fed put. And as far as Washington goes, I do think we are living in a period of uncertainty for now. I think investors are going to realize that a lot of great stocks have come in, hugely. And the S&P's down 10, but a lot of good stocks are down 50%. And I think that's why, there's a very good chance we made our low for the first half already, or maybe for the year. What has caught everybody off guard, including us, is that the tariff headlines, we understand, okay, Trump wants maximum leverage, so he's going to speak with as much force as possible, and that should rattle markets and leaders and try to force a negotiation. But I think what is surprising is how quickly business confidence has collapsed and consumer sentiment has collapsed, and actually it's actually dragged down economic activity. So I think we are now risking the economy hitting stall speed if we have tough talks. And look, it's pretty evident. This weekend it was a quiet weekend because I think they realized, this message of we're okay if the economy rolls, that's a huge tactical mistake because as soon as, do you remember what Fed Chair Powell said in August when he says there's pain ahead? That triggered a pretty big growth scare. The pre-announcements are a very bad sign because that didn't happen with other drawdowns, right? Like last August we had a 10%. It's not like companies were pre-announcing, things got softer. I think tariffs are a financial restructuring of the U.S. economy. So there's clearly a lot of uncertainty, but also everyone here needs to keep in mind a president can't restructure the economy unless Congress changes the law. It's obvious that if someone said, okay, who should be the bullseye of this tariff war, it really should be China, because we know China subsidizes so many things. And look at even processing of rare earth minerals, right? China has created a monopoly through their direct subsidies, and yet in all this public rhetoric, that's like the one country that's hardly named. And it shouldn't be like, oh, it's obvious because Trump knows we all don't. We know you need a new deal. I would probably interpret it to say they must be making progress, so he's decided not to sort of bash them to bring them to the table. And that would probably explain why NVIDIA has been outperforming as well. Yeah, I think if there was a global trade war and we risked a recession, NVIDIA would still be derating. The PE should be coming down because all of a sudden everyone wouldn't even know what the E looks like, But so the fact that that's stabilized, I think, is very telling. And at the end of the day, if you think about the next 10 years, I don't think it's lost on the administration that whatever we're fighting for, like onshoring, it's a very different argument in 10 years because in 10 years, robots are going to be very capable and AI is going to make the robots a lot more fire and forget. So if you want to make iPhones in America with like robots that have the dexterity of a worker in China, that's going to actually be economically possible. So maybe they're coming to some agreement on robot technology because China is way ahead of the U.S. on that. So I'm just guessing. I don't know.
Ultimately, Lee urges investors to focus on the long game. He's skeptical of the idea that investors should abandon U.S. equities just because valuations have risen. The U.S. market, he explains, still enjoys a rare combination of world-class companies, a culture of innovation, shareholder-focused CEOs, and a regulatory environment that, while not perfect, still outpaces most global competitors. If you're looking to diversify internationally, Lee suggests targeting countries with favorable demographics and workforce trends, such as India or parts of Africa.
The Fed put has always existed because, with the exception of Volcker, but Powell's talked about this, there's a recognition that the stock market is the sentiment indicator of the economy. Like if you tank the stock market, there's no GDP expansion. Consumer confidence doesn't go up if the stock market crashes. But that message got muddled the last couple of years because inflation made it hard for the Fed to actually try to support the stock market. And I'm not trying to rile the waters, but I think there is a political dimension because the White House is very divisive. Half the country didn't vote for the current president, and I think the Federal Reserve, even though they're independent, many of the people that work at the Fed, I think it's 94% of donations were to Biden's reelection. So it's clearly an institution that favored the party that lost. And I think that's why it's been hard for Powell to be like, I can ignore tariff headlines. I think because, he's got an entire organization that doesn't agree with him. But I think the put exists because 2 weeks ago, Fed Chair Powell was speaking, and he talked about in 2019, tariffs were inflationary, but he still cut rates 3 times. 33 years ago, the institutional investor said long-term meant 12 months. And so they didn't care about anything that you had to say unless it was going to change the 12-month outlook. And then probably in the 2010s, that changed to 1 quarter. Okay, so that was 15 years ago. And now in the institutional world, because of all these ways people measure factor and your risk and your value at risk, it's like 30 days. So people don't care if something's 31 days from now. If the stock's going down next 29 days, they're gonna sell. And people have instant liquidity. So it's not just like someone in Robinhood that can go to zero. Any major hedge fund can essentially turn their beta to zero. They can literally go to flat on the market with a push of a button. So I think the stock market does face rage selling now. And MIT had a very big headline study that came out in 2020 that said something like 57% of adult males rage sell. Meaning like, it's actually, so if you look at the stock market.
By rage selling, you mean they just irrationally come in and decide to sell on a hunch, like
Yeah,
they're done, or is there rage buying?
So they're literally like, imagine like a race car that's going 100 and 0. Like there's no speed in the middle. Whereas a female don't rage sell. So it's actually a gender thing, rage selling. Tariffs are so complex. Like Ken went through and tried to calculate tariff rates for U.S. bilaterally with different countries. And you can weight it by trade or you can do equal weight. And by the way, when you do that, none of the numbers match up to what Bank of America's tariff numbers are. Like nobody actually knows the real tariffs. I mean, it's really hard to calculate, which also means like, how can you by April 2nd negotiate 100,000 line items with like bilateral with all these countries? So I think that there has to be concepts that are agreed upon. And like, for instance, with China, very likely a lot of it has to do with AI and intellectual property, not necessarily steel and aluminum. I wouldn't recommend someone saying, well, the US is done, and so the next 10 years, because it got expensive, I'll just buy Europe. Unless you're really confident Europe has the same number of good companies with the innovation and regulatory freedom.
Oh boy, that's a big lineup.
And a buyback culture and a CEO obsessed with the stock price and employees who get a lot of stock so they care about what the stock does. And in a regulatory environment that's getting better, then you should buy that country. But just in the U.S.,
But you're answering your question. You seem to be cynical about whether that's actually available.
I mean, I'd make it more of a demographic play. Like I'd bet on Africa and India because they have got a lot of good things happen when you have surplus workforce.
Lee closes with a powerful reminder that while markets are volatile and the news cycle can be overwhelming, it's critical to remain focused on structural trends. Tariffs, political noise, and short-term volatility are all part of the game. But real wealth is built by looking ahead, staying calm, and investing in innovation, efficiency, and long-term value. Please like and subscribe.